A single misstep can cost tens of thousands of dollars in unexpected taxes. Retirement rollovers are a financial minefield for millions protecting lifetime savings. This complex process creates tax confusion year after year, affecting countless individuals and their future financial security. One truly significant issue involves the 60-day rule for indirect rollovers from an individual retirement account, often called an IRA. When you personally take money out of an IRA with the firm intention of rolling it into another IRA, you have precisely 60 calendar days to complete that transfer. It is a strict window. If you miss this non-negotiable deadline, even by one single day, the entire distributed amount becomes a fully taxable distribution. Imagine receiving a check for $150,000 from your IRA and then failing to redeposit that sum into another qualified retirement account by day 61. That entire $150,000 would be immediately added to your taxable income for that current year. This alone could push you into a much higher federal tax bracket, perhaps from 22% to 32% or even higher. For someone facing a combined 24% federal tax rate on $150,000, that is an immediate $36,000 in federal income taxes. Then you consider state income taxes, which could easily be an additional $7,000 to $15,000, depending on your state of residence. This 60-day clock starts ticking the moment the money physically leaves the first account. It is a stringent rule with very few exceptions, and those exceptions are extremely rare and difficult to prove. Missing this deadline is a shockingly common and devastating error for hundreds of thousands of retirees and pre-retirees across the nation every single year. It is effectively a 100% penalty on the full amount if not rolled over correctly. Such errors lead to significant financial hardship for many American families. Another profoundly confusing layer of complexity is the one rollover per year rule for IRA to IRA rollovers. The IRS strictly dictates you are only allowed one indirect rollover between all of your individual retirement accounts within any 365-day period. This rule applies to all your IRAs combined, not just one specific account. For example, if you successfully roll over $50,000 from your traditional IRA A to traditional IRA B in February 2024, you cannot perform another indirect IRA rollover from any of your IRAs until February 2025. If you attempt a second indirect rollover within that critical 12-month period, that second amount is considered a fully taxable distribution, and it is subject to ordinary income tax. Moreover, it is hit with an additional 10% early withdrawal penalty if you are under age 59 and a half. This final rule does not apply to direct trustee-to-trustee transfers where money moves seamlessly between financial institutions without ever touching your hands. That is a key and essential distinction. It also does not apply to rollovers from an employer-sponsored plan like a 401k to an IRA or vice versa. These minute distinctions are incredibly important to grasp. Many people misunderstand this one per year limit, leading to costly mistakes, costing them untold millions collectively in avoidable taxes and penalties. They might incorrectly believe they can do 5 indirect rollovers if they have 5 IRA accounts. That is absolutely not how this stringent rule operates. This restriction prevents individuals from using their IRAs like interest-bearing checking accounts, which the IRS strongly discourages. It remains a significant and often unexpected hurdle for many Americans. Then there is the persistent headache of 401k rollovers, especially when moving substantial funds from an employer plan to an IRA. If you unwisely choose an indirect rollover where the money is physically sent to you personally, your employer is legally required by federal law to withhold 20% of the distribution for federal income taxes. So if you decide to roll over $200,000 from your 401k to your IRA, you will only actually receive a check for $160,000. You then need to deposit the full $200,000 into your new IRA within the strict 60-day window to avoid taxes and penalties. This crucial step means you must come up with the missing $40,000 from other sources to cover the exact withheld amount. You will eventually get that $40,000 back as a tax credit or refund when you file your annual tax return. But it creates an immediate, substantial, short-term cash flow problem that many individuals simply cannot manage. This forced withholding often catches people completely by surprise. They mistakenly believe they can simply deposit the 80% they received and everything will be fine. Know that $160,000 is then considered an incomplete rollover, and the full $200,000 would be taxed as ordinary income. Plus, there is often an additional state tax withholding on top of the federal 20%, which can mean another 4% or 5% or even 6% more, depending on your state of residence. Some states have no income tax, but many others do, adding greatly to the overall financial burden. Direct rollovers solve this entire problem by having the money go straight from the employer plan to the IRA with no withholding. Always choose a direct rollover if it is remotely possible. It is the safest, simplest, and most tax-efficient path. For every $100,000 you roll over, indirectly you need to immediately find an additional $20,000 to cover the withholding. That is a truly tough ask for many retirees living on fixed incomes. Mixing pre-tax and after-tax money in traditional IRAs also creates massive confusion, especially with Roth conversions. If you have any non-deductible after-tax contributions in a traditional IRA and then convert a portion of your traditional IRA to a Roth IRA, the IRS applies a complicated pro rata rule. This rule states that a portion of every dollar you convert is considered pre-tax, and a portion is considered after-tax, based on the total aggregate value of all your traditional IRAs. You cannot just convert the after-tax money without inevitably triggering taxes on some of your pre-tax money. For instance, imagine you have $100,000 in a traditional IRA with $90,000 being pre-tax contributions and $10,000 being after-tax contributions. If you convert $10,000 to a Roth IRA, the pro rata rule means $9,000 of that conversion would be pre-tax and only $1,000 after tax. So you would owe income tax on $9,000 even though you only converted $10,000, and $1,000 of that was already after-tax money. This is a common and insidious trap for individuals attempting a backdoor Roth IRA strategy. Many people fail to correctly track their non-deductible contributions using IRS Form 860, and they get hit with significant unexpected taxes during a Roth conversion. This critical form needs to be diligently filed. Every year, you make non-deductible contributions, and it meticulously tracks your basis. Without it, you have absolutely no official proof of your after-tax money. It is a crucial document, often overlooked by hundreds of thousands of taxpayers across the country. Imagine paying taxes on money you already paid taxes on simply because of poor record keeping. That is a terrible and absolute double taxation nightmare for many individuals. Another immensely complex area involves inherited IRAs. If you inherit an IRA as a non-spouse beneficiary, you generally cannot roll it over into your own personal IRA. Instead, you must transfer it into an inherited IRA or account owned by beneficiary IRA. The rules around distributions from inherited IRAs are distinctly different depending on the date of death and the specific type of beneficiary. For deaths occurring after 2019, many non-spouse beneficiaries must fully empty the inherited IRA within 10 years from the date of death. There is no longer a stretch IRA option for most of these non-spouse beneficiaries. This means a $1 million inherited IRA must be fully distributed by year 10. If you inherit a Roth IRA as a non-spouse, you also face these 10-year distribution requirements. But the distributions are generally completely tax-free, assuming the Roth IRA has been open for at least 5 years. Spouses have much more flexibility. They can roll the inherited IRA into their own IRA, treat it as their own, or keep it as an inherited IRA. This crucial distinction between spouse and non-spouse beneficiaries is absolutely critical and often severely misunderstood, leading to stiff penalties if distributions are not taken correctly. The penalties for not taking required distributions from an inherited IRA can be 50% of the amount you should have withdrawn. Think about a required distribution of $75,000 that you mistakenly missed. That is a $37,500 penalty right there. It is a huge and often truly devastating financial hit. Many thousands of individuals face this specific penalty every single year because they do not understand these highly nuanced rules. The net unrealized appreciation, or NUA rules, add another highly specialized layer of complexity for those with employer stock within their 401k plans. If you hold company stock in your 401k, and take it out as a lump sum distribution, you can elect to pay ordinary income tax only on the cost basis of the stock when it was originally purchased. The appreciation, or the NUA, is then taxed at significantly lower long-term capital gains rates when you eventually sell the stock. This can be a huge tax advantage compared to rolling the entire amount, including the company stock, into an IRA where all future distributions would be taxed as ordinary income. However, to qualify for NUA treatment, the company stock must be distributed as part of a lump sum distribution of your entire 401k balance within a single tax year. If you roll over any other portion of your 401k to an IRA or another qualified plan, the NUA election is completely lost forever. Understanding the specific timing and distribution requirements for NUA can save tens of thousands or even hundreds of thousands of dollars for employees who have substantial employer stock. It is a very niche rule, but incredibly valuable and powerful for the right financial situation. Imagine having $200,000 in company stock that originally cost $20,000. If you correctly use NUA, you pay ordinary income tax on $20,000 now. The $180,000 appreciation is taxed later at 15% or 20% capital gains rates when sold. If you roll it all into an IRA, that $180,000 would eventually be taxed as ordinary income, potentially at 37%. That is a $30,000 tax savings difference right there on that $180,000 of appreciation. This often overlooked rule affects hundreds of thousands of long-term employees who have held company stock in their retirement plans for decades. Required minimum distributions, or RMDs, also significantly complicate rollovers, especially for individuals approaching or already past their RMD age. If you are legally required to take an RMD from an IRA or 401k, you cannot roll over that RMD amount. The RMD must be fully withdrawn first and taxed as ordinary income. Only amounts above the RMD can then be rolled over. If you mistakenly attempt to roll over your RMD, it is considered an excess contribution to the new IRA, which comes with a severe 6% excise tax each year it remains in the account. The current RMD age is 73, but it is scheduled to gradually increase to 75 in 2033. These frequent age changes make retirement planning even trickier. Many people mistakenly believe they can roll over their entire account balance, including the RMD portion, when transferring funds from one IRA to another. They then face a hefty tax bill for the RMD and an additional penalty for the excess contribution. Financial institutions are indeed supposed to help with RMD calculations, but the ultimate legal responsibility lies squarely with the account holder. This often means many tax returns need amending. The penalty for failing to take a proper RMD was previously 50%, but the Secure Act 2.0 fortunately reduced it to 25% and then further to 10% if corrected promptly. Even at 10%, a missed $70,000 RMD still carries a $7,000 penalty. This is a serious financial concern for millions of seniors nationwide. The precise timing of rollovers, especially when initiated near year-end, can also be profoundly problematic. If you initiate an indirect rollover in late December, the 60-day clock might unfortunately span 2 different calendar years. This could mean the distribution is officially reported in the current year, but the actual rollover is only completed in the next year. This tricky situation requires extremely careful tracking and absolutely proper reporting on IRS Forms 1099-R and 5498. Form 1099-R reports the distribution, and Form 5498 reports the contribution. Ensuring these vital forms match up correctly across tax years is absolutely critical. A mismatch can almost certainly flag your entire tax return for an audit or review by the IRS. For example, a distribution reported in December 2023 must be rolled over by late February 2024. If this is done incorrectly, the entire 2023 distribution might be fully taxed as ordinary income without the benefit of the rollover. This year-end trap catches hundreds of thousands of individuals every single tax season. It invariably means extra paperwork, extra stress, and potentially a much larger tax bill. It is a very common misstep, often leading to amended tax returns and protracted headaches with the IRS. State tax implications add yet another deeply confusing layer of headache. While federal rules largely govern the overall tax treatment of rollovers, some individual states have their own specific regulations or unique reporting requirements. Some states may not entirely conform to federal tax law regarding retirement distributions, or rollovers creating additional calculations and potential tax liabilities that are distinct from federal taxes. For instance, a few states like Florida or Texas have no state income tax at all, while others have high income tax rates that apply to retirement income. Navigating both federal and state tax codes during a rollover can become an extremely complex undertaking, almost always requiring expert advice. It is not just about the federal 20% withholding. Each individual state might have its own separate withholding rules or demand different reporting forms. This can easily mean dozens of extra pages on a tax return. For someone living in a state like California with a top state income tax rate exceeding 13%, that can add truly substantial costs to a missed rollover or an improperly handled distribution. A $150,000 taxable event could mean over $19,000 more in state taxes on top of federal. This varies wildly across the 50 states, creating an administrative nightmare. It is a patchwork of confusing rules and regulations that can easily trip up even the most careful planners. Penalties for early withdrawals represent another constant and unwelcome source of confusion. Generally, if you take money out of a traditional IRA or 401k before reaching age 59 and a half, it is subject to a 10% early withdrawal penalty in addition to your regular income taxes. Rollovers are a crucial exception to this specific rule. However, if an indirect rollover fails for any reason whatsoever, like missing the 60-day deadline, the entire distribution is then immediately subject to both income tax and the severe 10% penalty. This penalty can be truly substantial. For a failed $150,000 indirect rollover for someone under 59 and a half, the tax bill could easily be $36,000 in federal income tax, plus $15,000 in federal penalties and state taxes, often another. $10,000 on top of that. That is a $61,000 hit on $150,000, which represents over 40% of the original amount. There are some limited exceptions to the early withdrawal penalty, like distributions for first-time home purchases, up to $10,000 for qualified higher education expenses, for unreimbursed medical expenses, or if you become totally and permanently disabled. But these exceptions are very specific and often poorly understood. Relying on an exception without fully understanding its precise limitations can be another devastating financial trap. Thousands upon thousands of people accidentally trigger this 10% penalty every single year because they do not fully grasp the detailed rules. Finally, the sheer volume of misinformation and conflicting advice contributes most significantly to the overall confusion. The financial landscape changes constantly with new federal legislation like the Secure Act and a Secure Act 2.0. The Secure Act 2.0, for instance, made many profound changes, including delaying RMDs to age 73, and then later to 75, and allowing for more penalty-free withdrawals for emergencies, such as up to $22,000 for domestic abuse survivors. Keeping up with these rapidly changing laws is a full-time job, even for professionals. Many individuals rely on outdated information or advice from non-experts, leading them far down the wrong and costly path. The IRS itself publishes hundreds of pages of intricate guidance on retirement plans and rollovers. Even seasoned tax professionals spend hundreds of hours annually staying current with these evolving regulations. For the average person attempting a rollover without solid professional advice, the chances of making a costly mistake are exceptionally high. The rules are undeniably designed to protect retirement savings, but their sheer intricacy often creates far more problems than solutions for those who are not experts. Many millions of people get tripped up by these rules, annually losing billions of dollars collectively. We are talking about hundreds of thousands of incorrect tax filings each year directly related to retirement plan distributions. The IRS estimates that around 85,000 individuals annually face penalties related to RMD errors alone. These are not minor errors, often resulting in thousands of dollars in penalties. The government misses out on collecting billions in correct taxes, and individuals collectively lose billions in retirement savings due to these easily avoidable errors. It is a system designed with good intentions, but one that ultimately becomes a labyrinth for a staggering number of Americans. Understanding these incredibly complex details is truly a full-time task for anyone involved.